Hey there, everyone. Welcome to our latest episode of the Market Misbehavior podcast. My name's Dave Keller, and here on the Market Misbehavior podcast, our goal is to have great conversations with great market practitioners, authors, educators, money managers, traders, strategists, anyone else that we think has a great perspective, great stories to tell, good lessons learned that they're willing to share with all of us as we have a brief conversation about the market environment, how it's evolving. Today, a really fantastic conversation with Chris Verrone. Chris is the Chief Market Strategist at Strategas Research Partners, joining us from his office in New York. I've known Chris for a number of years, and back in my institutional investor days, I used to enjoy frequent visits up in the Boston area from Chris and his team. Chris is a fantastic technical analyst, arguably one of the best on the street. And has great experiences. What's so striking about my conversation with Chris is very early on, see if you can catch it, he talks about how he had goals for this year. This is a guy that has had a successful career in the investment industry. He's arguably probably the most well-known technical analyst on the street, quoted all the time in financial media. And the fact that at this point in his career, he's still actively thinking about what could I do better in 2025 that I did not do as well as I could have in 2024, and I think that speaks volumes about who Chris is and really represents, I think, the best of the technical analysis community. Chris and I talked about a number of different things. We talked about process. We talked about his technical approach, how he has gone on a journey of a very simple approach through his career, going to a much more complicated, much more indicator-heavy approach, and now at this phase, sort of coming back to and recognizing the benefits of keeping it simple and just having very straightforward ways with which you analyze market conditions and watch and just watch for signs that should change. We talked about the strength in gold, silver, precious metals. He suggested he saw some potential downside after the incredible runs that we've had. Did not see incredible downside in Bitcoin and cryptocurrencies, as Bitcoin pushing above 110,000 as we recorded our interview. We talked about what he was seeing and hearing going into that April 7th major low, how the conditions really suggested a tactical bounce, and then more broadly, how you balance and how you relate short-term strength and weakness, or the tactical call with the long-term call. And he would argue that the long-term trends, the long-term perspective, that's where he feels he can add the most value. And I think that's well said. One of my favorite quotes, very quotable interview, one of my favorites was, "Whatever your target is, it should be higher." I'll let you listen to the interview to see where he said that, what he was suggesting. But great conversation with one of the best technical analysts I know, Chris Verrone, Chief Market Strategist at Strategas Research Partners. Super excited to be catching up again with Chris Verrone. Chris is the Chief Market Strategist at Strategas Research Partners in New York. Chris, it's been a little while since we've spoken. I feel like there's plenty of market action to talk about, but it's great to see you again. Welcome back.
Dave, it's great to see you. It's great to be here. Thank you.
I feel like there's so much we could cover in a short period of time. Before we get to the current markets, before we get to a number of different charts, which I love to throw at you and just see where your head is at, tell me this. I mean, just quickly summarize how would you describe your technical approach? I've followed your work for many years. Most people listening probably have not had the pleasure of that. How would you describe how you approach the market every trading day?
So I would say constantly evolving. I think you have to constantly evolve to what the market gives you, to new regimes, to new indicators, to new approaches, but really for me, always based on the tenets of what I like to call it. I know it sounds contradictory, but what I like to call bottom-up macro, meaning looking at all the stocks everywhere in the world and arriving to some macro conclusion about the signals from the individual equities. I've always felt that the best way to do macro is actually through the lens of stocks. So bottom-up macro is how I would describe my process. As I say to clients, particularly when I'm meeting new clients or prospects, I say, okay, listen, I try to accomplish three things every day. The first is easy. When you look at thousands of charts every day and every week, I think in 20 or 30 or 40 minutes, I can show you something thought-provoking, something provocative, maybe something that changes the way you think about the world. That's always my first goal. The second goal, Dave, as you know, you've done this for a long time, is admittedly more challenging. It's to attempt to be correct as often as possible. I will humbly concede I am no more right or wrong than anyone else out there, but you do know when you're seeing the ball well and when you're not seeing the ball well. And I think it's my job as an analyst to, frankly, tell clients, listen, I'm seeing the ball well here. Or listen, I don't understand the puzzle pieces here. Here's what's maybe most important, but I'm not sure which way this is going to break. I think honesty when you're communicating with clients or colleagues or peers in a game that's very difficult is important. I'll never be dogmatic in my work. And I think that is such a sin, particularly on the sell side, when you come across just the dogmatic approach to markets. It's too hard to be dogmatic. As the facts change. And then third, as you know, Dave, I used to come up and always see up in Boston. I spent 100 days a year on the road, not because I enjoy airplanes, but because my best ideas are all stolen from other people. When you're an analyst, I think you got to strike the relationship between how much time you spend staring at the screens and how much time you spend talking to people. Yeah. And I know I need to break that up 50-50 because I get just as much value and insight talking to other people, particularly people who don't do technicals. And that's what's key. 99% of people I talk to on a daily basis do not do charts, do not do technical, certainly like we do. It's so important for me to hear that perspective. It's important for me to read newspapers. It's important for me to really increase the number of inputs into my process.
You hit on so many great things there, Chris. And I love, that description of what I would say, sort of what you should be doing as a kind of traditional sell-side technical analyst, or in your case, at a successful independent research shop. I think that's spot on. And I don't miss everything from my Fidelity days, but I do miss having people like you come in and being able to, have just conversations about what we were seeing and what we were hearing. And I think you're right. I think we all gained a ton from just having those conversations.
Totally.
So set the table for where we're at here. We'll talk about some of the market conditions and what we've seen. We've obviously had a significant reversal from the April lows to where we're at. I want to start, if we could, at those April lows. This was actually a tweet you put out on April 4th. Missing for weeks was stress in put call ratios and any evidence of capitulative or indiscriminate selling. Those boxes now checked. Gold being sold sharply reflects this too. In the final phase of a decline, no place to hide. Probably close here. Not bad, Chris, in terms of timing going into a significant low in April. But can you talk to us a little bit about that idea of capitulation? I feel like, when the market's going down, people get really nervous and the pessimism usually peaks at the low. Can you talk a little bit about the conditions that you saw sort of going into that period? What gives you the confidence to think, okay, we're near the end of this and we want to start, thinking more upside potential?
Yeah, confidence is a dirty word in this business because you got to be careful. But listen, I would say the real tactical calls have never been our strong suit. Yeah. I think I'm just better at kind of longer term trend following, thematic identification, and kind of using the charts to do that. One of my New Year's resolutions this year was actually to try to be more tactical. Not because I think there's great value from a trading perspective in the tactical, but because it allows you to play the strategic or it allows you to play the longer term call from a more strategic vantage point. And that was kind of our, every year you want to be getting better and improving your process. And that was one of my goals for this year. And frankly, we got lucky in, early to mid-February with a cautious call. I don't short uptrends, but I didn't like what was happening under the surface. I didn't like the internals were weakening. I didn't like the asset managers had all corrected. Some of the leaders were giving way. Yeah. I didn't think we would trade to 4,800 S&P. I thought we'd get a correction to 55, 5,600, and it would be kind of viable in the context of an uptrend, certainly accelerated through March into April. And kind of by the time we got to April 4th, 5th, 6th, 7th, I think that tweet was timestamped the 4th, put your thumb on that weekend, and you had all the conditions that generally present themselves near some type of a tradable low. And listen, our view or our call to clients, and we hosted a call that Sunday night, and we basically said, listen, I don't care if you're the most bullish person over the long term or the most bearish person over the long term. What you have to recognize that has happened over the last several days is we've checked the sentiment extremes, we've checked all these evidence of indiscriminate selling, right? That's the sell whatever you can, no place to hide. We saw, I think at one point on that Monday, you only had about 7 or 8% of the S&P above the 200-day moving average. Yeah. Even in the most apocalyptic bear markets, you have rallied from that condition. And my gut was that we probably rallied 56, maybe 5,700 over the next, 8, 12 weeks, as is typically the playbook. And then we'd have to make a call. We'd have to evaluate the character of the rally, make a call. My gut was it would probably fail. But as the rally matured, I was like, listen, this looks better than I would have expected 4 or 5 weeks ago. We've seen the internals improve. Listen, I'm not sure I would call this rally A++, but it's been A-. We've had the 1-month highs expand, particularly the cyclical sectors. I mean, at one point last week, you had 97% of tech above the 50-day moving average. You had 95% of industrials above the 50-day moving average. It reflects the return to momentum. So if you think about where we were on April 4th to where we are today, I think the trick right now is, again, differentiating between your tactical view and your strategic view, because tactically we're up 20+% in 30 trading days, and we can certainly pause or consolidate. And rates, we wrote this morning, rates are as good a reason as any for this market to consolidate or pause. It could be any reason. It happens to be rates. My gut says, if you thought a month ago we'd rally and we'd fail and that could be exploited, I think your thinking today has to be, okay, if we come in here, it can't be exploited. It's going to stay contained. And I think it stays contained into the 55, 56, 56.50 zone. I'm not a big level person. I kind of subscribe to the view that this is not a precision business. This is a put your thumb on the chart. And if you can get it within the eyesight of your thumb, you've done a pretty good job. And that would be my gut. Put your thumb on the 50-day moving average. You probably get pretty good support on any near-term consolidation. But a lot of the things we see are telling us think more optimistically relative to the consensus.
Yeah. So talk to me about how you triangulate. I mean, obviously the S&P's had an incredible rally, right, from the April low up to where we're at now, sort of, stalling out around that 5,900-ish level. We also have a situation with the dollar, probably breaking down, or in the process of maybe breaking down, rates pushing higher. How do you triangulate the technical view of strength off of the lows versus some macro conditions? I feel like it's not hard to list off a bunch of macro reasons why the market arguably should go lower, right? We can come up with reasons pretty easily. How do you balance those two between higher rates, weaker dollar, which, implies some, maybe some caution, versus price action that's been fairly constructive?
I think the macro on balance is probably why I would be reluctant to say the rally's been an A+ off the lows. I mean, what I'm trying to figure out, and this is why this business is so great, where you think you have these puzzle pieces and you're like, well, if I'm right on this, then I can't be right on that logically. Well, there's some humor in that, because it's assuming that you're that those two puzzle pieces that you think are opposing are actually opposing. And I'll give you an example of that right now. I am a, lack of a better phrase, for the past year, since last summer, I've been a raging yen bull. I am a dollar yen bear. I'm a raging yen bull. I think yen's going to 120 and all the like. But man, if yen's going to 120, am I dead wrong on stocks? So like, that's the conflict that you see in your work sometimes. And when I say there's almost a hubris in thinking that that you're seeing the ball so well that you're going to get it right twice. Oh, that you get dollar yen right and you get the stock call right as well. That's where I kind of go back to my knitting and I say, okay, I have a view on dollar yen. I have a view on equities. I have a view on oil. I have a view on gold. Let's keep them in their own domains best we can. Because the moment you start thinking too, well, if this happens, then that happens, and this happens, and that happens, next thing you know, you're 4 or 5, steps down the sequence, and you kind of forgot what the main point was. So I actually, I do macro. I do macro through the lens of the equity. But I feel like I make mistakes when I try to get too linear or or extrapolate too much in my thinking.
There's so many great points that you made in there, Chris. And I feel like so often investors try desperately to simplify and maybe oversimplify and just come up with these very simple factual relationships between different different things. And if this happens, then that has to happen. And I always try to remind people, those are often tendencies. They're not guarantees, right? I mean, it tells you what could happen, or maybe what has often happened, but something different has always happened, I feel.
I mean, Dave, just look right now with rates and dollar, right? For
Yeah.
much of the last 2 years, until the last 2 months, rates and dollar moved in step with each other, and then stuff changed, right?
Yeah.
So you can have the nostalgia for the prior correlation, or you can just play the ball as it lies. And I think the thing about this business is you have to play the ball as it lies. That relationship has been severed. I don't know why, but it is. It's unusual in the context of historically that you get rates up and dollar down in developed markets. That's generally something that's been historically reserved for emerging markets, but it is what it is. And then conversely, when I look at some of the stuff going on globally, I have bond yields up in Germany. German 30s look like they want to break out, and we know what Japanese 30s have done. And I was looking to the financial media the last 24, 48 hours, and everything I read is like, oh, the move in U.S. bond yields is because of the tax bill or the deficit. Well, there's no tax bill in Germany right now. There's no tax bill in Japan right now. So there's some global nature to this move in yields. The difference in those corners of the world right now is those currencies are actually going up. So I've thought about this, and I think if there's a criticism, certainly of my own thinking or my own work sometimes, but most people in general, we tend to use indicators that helped in the last war, but you don't know if they're going to be relevant in the new war or the new regime. And I think credit is a great example of that, where 07, 08, credit was a lifeline. It kept us out of trouble. It told us something was wrong. And I wonder if it was so helpful then, because that was really kind of a crisis of corporates. And you look at today, I don't think what's going on is about corporate stress. What's going on is the reordering of how capital moves around the world. So FX is probably a much better barometer of macro stress than credit might be, because this is not about corporates. Corporates seem fine. This is about how is money moving around the world? Are we deliberately changing that? And therefore, is the currency not the best barometer of it? If so, I think the shift with hey, rates up and yen up is a really important shift, because it's not what I would have expected. And that's the other thing that we really try to emphasize in our work. I can tell you what I'm seeing and all that. You're probably seeing it too. I think it's more valuable if I tell you what's surprising me, right? Because sometimes there's this, especially when you're on the sell side, you want to ignore what doesn't really fit in the story you're trying to tell. That is so unhelpful. I want to emphasize what doesn't fit my story, because it means that the market's telling me something I don't quite understand. So
that's where the message might be, right?
That's kind of where I spend exactly. So I try to spend more time trafficking the what is surprising me right now. I'll give you an example. Everyone I talk to for 2 or 3 weeks, right? Why are rates up? Tax bill's going to add to the deficit. Fiscal condition of the country, stagflation, any number of reasons. Well, is it possible rates could be going up because growth expectations might actually get better from here? I mean, I have industrials making new relative performance highs. I at least want to be open to that. And that's the thing you just see that we desperately try to avoid, is this idea of being so dogmatic where you're not open to something looking really different. And this is certainly not original thinking. I mean, these are all ideas that I've picked up and stolen along the way and I've incorporated into my own. I had the very good fortune last year, we do a big macro conference every year. I'm sure, Dave, you've attended in the past. Yeah. And I had the pleasure of doing a fireside chat with the now Secretary of the Treasury. And what Scott and I talked about was this idea of imagination. And as an investor or a practitioner, spending part of your day thinking about what could look wildly different 6 or 12 months from now is a very useful exercise.
Yeah.
And like an example, at the time, so this was, Secretary Bessent and I, this was in April of 2024. So six months before Trump would win, 6 months before the nomination. So we were talking as two market people, two investors. and dollar yen at the time was 160. And he said, imagine a world where it's 135. What does that world look like? And I mean, it turned out to be spot on. And what would you have thought would look different in that environment? Or I think today you could say, I don't know if it's my base case, but what does the world look like in 6 months or a year if gold's 2,500, not 4,000? It doesn't have to be your base case. It can be a very helpful thought exercise in preparing you for if something changes.
That's a big difference in your goal as an analyst, as a strategist, instead of trying to be right, which obviously it's better and it's more fun when you are. Right, I don't mind being right, but just thinking in terms of probabilities and thinking in terms of potential outcomes, I think that's a really intelligent way of approaching what we're all trying to do.
I do think like as you mature in this business, or as an analyst or an investor, you almost kind of return to where you began. I think particularly technicians like have this arc where like they begin very basic. Okay, is the 200-day moving average upward sloping or downward sloping? Then they develop this inferiority complex along the way where they got to sound smarter or more intelligent because they're competing against the fundamental guys, and they need more indicators and more complicated models. And you kind of go up that arc, and then you realize like, well, that's actually not helping me. That's not helping me. Then you return, 20 years later to kind of where I am now. Like, okay, is the 200-day moving average upward sloping or downward sloping? Give me that, and then we can talk about everything else. So it's kind of been fun to see that over. This is my 21st year in the business. It's been fun to see that arc of my own go from kind of simple to probably too complicated back to simple.
And I feel like one of the great values, Chris, you probably provide in 2025 that probably you're uniquely equipped to do now is you've had all of those years of going through that cycle and you're at this particular point. To finish off, if we could, can we go rapid fire through a couple different markets and just give us a sense of where we're at? You mentioned gold briefly. Precious metals have had an incredible run. Gold, silver, sort of threatening new all-time highs. Both have sort of pulled back here recently. And to many, I think, have surprised to the upside. What's your take on gold here, silver at these points, given the run they've had, the recent pullback?
So I have a hypothesis and then I have reality. And I think the reality is, the longer term trend is still up. My hypothesis is that we're in the process of some blow off here in gold. And you go back to mid-April, there was a day, it was overnight, where gold was like 32% above its 200-day moving average. Even in the great gold bull markets of the 2000s and the 1970s, that was typically about the upper limit. You would get a good 20% smack in the face when it would get that extended. So 20% down from the highs is like 2,800, 2,750 on gold. I think that's possible. I say it's my hypothesis at the moment because I would really want to see that 50-day give here again to lean into that view. But the flows are excessive. There was a day in late April where call volume on GLD was like the highest of all time. So what began 2 years ago, I think, as a kind of very orderly bull market that was ignored, in the last 8 weeks became kind of an unorderly bull market that is no longer ignored. A bit of a retail frenzy has been set off. I want to be open to at least an intermediate term top taking shape here. I've cut my gold in half. I have not shorted it yet. I've cut my gold in half. Listen, we go on to make new highs. I'll add it back, but I've cut it in half here.
I have to ask about cryptocurrencies with Bitcoin making new all-time highs here.
That's where my half gold went.
Well, there we go. Because that was going to be my follow-up question. If you're taking it off, where do you put it? I mean,
the great thing when you're on the sell side about trading gold and crypto is it requires no compliance approval. So this is where I spend my time.
It's the Wild West of market commentary. Where's your head at in terms of Bitcoin now round tripping back to previous highs, making new all-time highs? The structure obviously behind Bitcoin with ETFs and everything has changed. Where's your head at in terms of the current conditions here?
So a couple things. I'll start with the most obvious. I think whatever your target is, it should be higher. That's an old, I think it was Barton Biggs or Byron Wien used to always say, okay, pick a level or pick a direction. Don't pick both, right? So I'm just going to pick a direction. I think the direction's higher.
Yeah.
That's number one. But I've enjoyed Bitcoin because I love when I make money in something, but I've gotten the reason why wrong. I think it's a very satisfying feeling, and only a technician can experience it, because the reason why something may or may not happen is the least important thing on my list, right?
Yeah.
But I still am a human being where I think this will go up because, right? I thought Bitcoin was likely bottoming in, late March, early April. But I got the reason dead wrong. I'm like, okay, Fed's coming, Powell's going to sound dovish. And like none of that's happened, yet it still worked. And I got to participate because I underweighted the why and I overweighted the what. And the what was the chart. So it's there's the inverse to that too, where you get the reason right and you get the call wrong. That's the most frustrating thing in this business. We try to avoid that one.
Yeah.
But I like it higher here.
That's awesome. So the final question then, when you're looking at the equity space, obviously the S&P stalling out a bit here. Growth stocks that had incredible runs have kind of stalled out. Sectors like industrials, I think you mentioned that earlier, really improving on a relative basis. When you're looking forward through a period of uncertainty, what stands out as an opportunity on the equity side?
Like what I love about the market is it gives you the answers. It's like, okay, we've been in this weird tape for 8, 12 weeks. Show me the relative high list and show me the relative low list. Okay. At least I know where I can traffic. And like you're telling me you were underperforming on the way down and you've underperformed on the way up? No thanks.
Yeah.
I mean, housing and home building didn't work on the way down, hasn't worked on the way up.
Still not working. Yep.
Power's worked on the way down and the way up. GEV, Siemens, Mitsubishi Heavy. I was trying to figure out the other day, and this is why it's good to be around smart people and talk to people. I'm like, these home builders trade awful, but why is Trane and Carrier and JCI all making new highs? Oh, they're building the cooling systems, not for the new houses being built, for the data centers. That's why, right? So you pick up the story after you've identified the chart. So I think the industrials are in good shape here. Financials globally have continued to hold their own. I don't see a lot wrong there. If there's maybe one blemish in financials, some of the publicly traded private stocks like Apollo and the like may be weakening here. I've been underwhelmed there. I don't see a ton going on in staples of any interest. I don't see a ton going on in the REITs of any interest. I think discretionary is probably a little bit better than advertised here. Not the durable side, but the service side is generally pretty good. So that's kind of where we're playing here.
Great reminder to focus on what's actually working. And you've mentioned relative strength another time. When I hopefully have you back on the show, we'll dig into that a little bit further. Chris, awesome as always. Can't thank you enough for sharing some insights. You've been doing this for a number of years, and the fact that you're telling me about goals you have for 2025 and still trying to improve your game at this point is pretty remarkable. It hopefully tells people the kind of person you are, and wish you much success as always.
Thanks. Hey, a lot of fun as always. Thanks again for having me. Take care.
All righty. Hope you enjoyed that conversation with Chris Verrone. Chris is awesome. I don't know if you noticed, I didn't have a chance to ask him, but did you notice off of his right shoulder in the background, all those framed magazine covers? It's fantastic. That's an exercise in what we call contrary opinion. Back in my Fidelity days in the chart room, we had a huge wall-sized paper chart where we would have little magazine covers notated, because we often found at going into major tops, magazine covers would get very bullish and very optimistic. Going into major lows, magazine covers would get climactically negative. And so watching for those extremes as a contrarian is super helpful. So fantastic that that's the backdrop. As we're talking about the tactical reversals, we're talking about short-term versus long-term, and focusing on some of those potential evolving themes. At the end, I think his ideas about where to focus on. If you think about how he answered my question, I asked him, where do you focus? Where do you see opportunities? And his answer was essentially, here's a bunch of things, but it was basically, I'm looking at what's working and I'm looking at what's not working. And I think probably what I love so much about Chris, besides him being a genuinely nice human being and very gracious and generous as always with his time and expertise, is that he kept things very, very straightforward and sort of just shared, look, I think at the end of the day, it's focusing on what's working. It's focusing on what's not. It's looking at the charts. It's consistently analyzing them, but also getting outside of your shell, your cockpit, your comfort zone, and exchanging ideas with others. And so I think the essence of what Chris talked about really resonates with me in my own process, and I hope very much that it resonated with you here today. That's it for today's episode. By the way, if you want to learn more about some of the technical tools we talked about, how you can look at charts of gold and Bitcoin and other stocks and ETFs and asset classes and draw some important conclusions based on trends, momentum, breadth, and other things we talked about today, if you want to upgrade your own use of that toolkit, our Market Misbehavior Premium memberships may be a really good idea for you. 3 great benefits to the premium membership. Number 1, you'll have immediate access to all of our virtual courses. We start with Flight School Behavioral Investing. We'll teach you all about behavioral biases, about technical analysis tools, and developing good routines as an investor. You will also have access, second benefit, to our members-only reports like our weekly flight plan, where we look back at the week that just happened, what was new, what was different, what was meaningful. We look forward at the week to come. What levels, signals, patterns are we watching for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community, where you can ask questions of me. I'm in there every morning answering questions, sharing ideas, sharing charts, trying to educate as much as I can. You'll also benefit from other like-minded investors as they navigate these markets, as they ask questions. It's a great learning opportunity, great supportive space to navigate these markets, great place to get questions answered. All of those benefits can be yours if you check it out today. Go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.